Today, I want to talk about something that should make you very uncomfortable. Over the last 18 months, tech companies have committed over $200 billion to AI infrastructure spending. I'm not talking about building useful products or generating actual revenue. I'm talking about buying server farms, GPUs, and data centers at a pace that would make a fueled Wall Street banker in the 80s say, hey, maybe pump the brakes. Because Microsoft announced they're spending $80 billion on AI infrastructure in 2025 alone. Google's throwing down $75 billion. Amazon, Meta, and a dozen other companies are following suit. And if you add this all up, we're looking at the largest coordinated capital expenditure binge in modern corporate history, which would be great if there was actual demand driving this. But here's the problem: there isn't. This now brings us to the uncomfortable question nobody in Silicon Valley wants to answer. Who's actually paying for all this AI? Because right now, the AI economy looks less like a revolution and more like a very expensive game of hot potato played by people who should know better. I'm going to paint a picture for you. Microsoft buys $50 billion worth of NVIDIA GPUs to build AI infrastructure. Google does the same thing. Then these companies turn around and sell AI services to each other, and to startups that are also spending venture capital money on the exact same infrastructure. It's a circular economy where everyone's revenue is just someone else's capital expenditure. Wall Street is eating this up like it's the second coming of the internet boom. NVIDIA's stock has gone up over 600% in the last 2 years. Their PE ratio is sitting at around 50 times earnings, which for a chip company is absolutely insane. For context, Intel trades at 20 times earnings, AMD at 35. But NVIDIA gets the premium because they're the AI darling, the picks and shovels play, the can't-lose investment. Except, there's one tiny problem. If the customers building AI infrastructure can't figure out how to monetize it, NVIDIA's growth story disappears faster than your ex after seeing your LinkedIn update. Here is where it's about to get interesting. Because we've been here before, almost exactly like this. I'm talking about the fiber optic bubble of the late 1990s and early 2000s. Back then, telecom companies spent over $500 billion laying fiber optic cables across the country. The pitch was simple. The internet is growing. We need more bandwidth. Build it, and they will come. And for a while, everyone believed it. Companies like Global Crossing, WorldCom, and Level 3 Communications were Wall Street darlings. Their stocks went to the moon. Investors couldn't get enough of the fiber optic revolution. But now here's what actually happened. They overbuilt. And I mean, by a lot. Telecom companies laid enough fiber to support 100 times the actual demand. And when reality caught up, the entire sector collapsed. Global Crossing filed for bankruptcy. WorldCom became the largest bankruptcy in U.S. history at the time, and investors lost hundreds of billions of dollars. The equipment manufacturers who sold all that fiber optic gear, companies like Nortel and Lucent, they collapsed too. Because when your customers go bankrupt, it doesn't matter how good your product is. If you look at what's happening with AI infrastructure right now, the parallels are disturbing. Tech companies are building massive AI data centers with no clear path to profitability. They're spending billions on GPUs that depreciate faster than a new car. And they're all betting that somehow, some way, someone will figure out how to make AI profitable at scale. But nobody has. OpenAI, the company everyone points to as the AI success story, is projected to lose $5 billion this year. Anthropic is burning through cash. Every AI startup you've heard of is operating at a massive loss. And the reason is simple. The cost of running AI models is astronomical. It costs OpenAI an estimated $700,000 per day just to run ChatGPT. And that's with millions of users. The unit economics are completely upside down. They lose money on every interaction and can't make it up in volume because the infrastructure costs scale with usage. So then the question would be, who's actually making money in the AI economy? And the answer is pretty much just NVIDIA and the cloud providers selling compute. Microsoft makes money selling Azure AI services to companies that are funded by venture capital. Google makes money selling cloud compute to startups that haven't figured out their business model yet. It's a beautiful system as long as the money keeps flowing. But the second the venture capital spigot turns off, or investors start asking uncomfortable questions about profitability, this whole thing unravels. I mean, don't get me wrong, AI is real technology. It's impressive. It will probably change industries. But there's a massive difference between transformative technology and profitable business models. Because the internet was transformative, but that didn't stop thousands of dot-com companies from going bankrupt. The fiber optic network was transformative, but that didn't save Global Crossing. And AI will be transformative, but that doesn't mean the current crop of companies spending $200 billion on infrastructure won't get obliterated when reality sets in. Because here's where the institutional investors start to get nervous. The Magnificent Seven tech stocks, the ones carrying the entire market right now, are the exact same companies betting their futures on AI infrastructure. Microsoft, Google, Amazon, Meta, they're all in. And they're not just allocating normal CapEx budgets, they're going all in. Microsoft's AI infrastructure spending is up 300% year over year. That's not a rounding error, that's a bet the company-level commitment. Wall Street is pricing these companies like the AI revenue is already here, like it's a sure thing. But if you actually look at the numbers, the AI revenue these companies are generating is a rounding error compared to the infrastructure spend. Microsoft reported $10 billion in AI revenue last quarter. Sounds impressive until you realize they spent $20 billion on AI infrastructure in the same period. Google's in the same boat. They're spending more building the AI infrastructure than they're making selling AI services. So, what happens when investors realize this? What happens when someone asks the obvious question, where's the return on investment? Because right now the answer is, trust us, bro, it's coming. And maybe it is. Maybe in 5 years, AI will generate trillions in revenue, and we'll all look back at this moment and laugh at the doubters. But maybe, just maybe, this is 1999 all over again. Maybe we're in the middle of a massive capital misallocation cycle, where everyone's building infrastructure for demand that doesn't exist yet. And maybe when this bubble pops, it's not going to be pretty. So, what's the scary thing? The companies making real money right now, Nvidia, TSMC, the cloud providers, they're all priced. Like this growth is sustainable forever. Nvidia trades at 50 times earnings based on the assumption that tech companies will keep buying GPUs at this pace indefinitely. But what happens when Microsoft looks at their AI division and realizes they've spent $100 billion and still can't figure out how to make it profitable? What happens when the CFOs start asking questions? What happens when the infrastructure spending slows down? Because this is how bubbles pop, not with a bang, but with a slow realization that it's simply not as it appears. It starts with one company missing guidance. Then another company announces they're slowing AI CapEx. Then the analysts downgrade the sector, and suddenly everyone's asking why they were so confident that this time was different. And that phrase, this time it's different, well, those are still the 4 most expensive words in investing. So, my question for you is this, and I actually want to know where you land on this. Do you think A, this is a legitimate infrastructure build for a transformative technology and the revenue will eventually catch up? Or B, this is the fiber optic bubble 2.0 and we're watching the greatest capital misallocation event of the decade in real time? Or C, something in between, where some companies figure it out and most don't, and we get a messy shakeout that takes years to resolve?